Hi guys, welcome back to another video by KayaPlus. So today's topic or company of interest will revolve an upcoming hot company because this company allegedly is aiming for IPO on the Malaysia Stock Exchange. It is a brand that I think most of us Malaysians are very well aware of, and we have also seen how this company grow along the years. So I think it has reached a certain size, and the management of company has decided to make the company public. So once the IPO prospectus was leaked out, and then of course there's a lot of interest and also a lot of talk about the company. And of course, our job today is to go through the numbers and find out whether this company can buy or not lah. But this is a personal opinion, doesn't constrain you to do any buy or sell decision. So here's the disclaimer. It is purely our own analysis and also our opinion of the company based on what is available inside the IPO prospectus. So without further ado, let's dive into the IPO info. So what important information that retail investors need to take note of inside or at the first step inside this prospectus?
Yeah, if you check out the IPO prospectus documents, there are tons of information that you can find out. But if you are interested into the IPO details, the key thing is about the listing price is not announced yet. So this is the key information that's not uh, released yet. But then there's something that you actually can take notes. So the percentage of share that they're offering for sales is about 12.2% based on the initial proposal. And then, of course, if there's any oversubscription, they may consider to extend it to 15%. So bear in mind, the requirement set by Bursa Malaysia is when you go for listing is about 25% as a minimum requirement for you to actually make it up for sales. But again, they are asking for a special approval, and it's also listed in the IPO prospectus. So this is one of the information that you should check it out. And of course, this is the breakdown. If you wanted to understand what is the number of share that eventually can go through balloting, and you and me as a public person can try to get the things. So this is the number. So who is selling the share? So essentially, this company is owned by the founder, called Li Tianhua. And then, of course, the one that actually going to let go the share for public sales is from himself, and also another key shareholder and also non-independent and non-executive director, which is Ng Li Tian, which is the founder's wife. So you can see 11.7% and also 0.5 add up to 12.2. And of course, they was think, what about the remaining share who own the entire company? So the answer is essentially still owned by the founder, Li Tianhua, and of course, through the holding named Li YG Holding. Right. So this is some of the information that you should know. So essentially still hold by the founder, about 85%, and then 15% they are letting it go for IPO.
Good.
And of course, the breakdown of it, we don't have any insight yet. So this is the proposed for usage. For usage, you can go for outlet and also distribution center expenditures, repayments, display fees, and expenses for public issue. So the breakdown will be available sometime soon. So before I go into the business info, anything to add, Jupan, on the first class on the IPO information?
Not much, just that I think I find it weird that they want to get a special approval from Bursa that they might not be listing 25% of their stock on the share market as per regulation. So I don't know for whatever reasons, but it's just weird lah. It shouldn't
Yep.
be for malicious intent, but it's just weird upfront. Yeah, right. Rules are
Yeah,
there
but
to be followed.
but there isn't any official statement share like why and so on, but they literally put it inside the prospectus. So I think we'll move
Yeah.
on the business info. Of course, every Malaysian know about Speedmart, but maybe some of the things
Yeah.
that you may not be aware is how big they are. So they have about 2005 outlet based on the documents, and of course, it's not just in Peninsular Malaysia, and they also have the footprint in East Malaysia. And essentially, their
Yeah.
target is with all these IPO activities, they plan to expand to 3,000 outlets across Malaysia by the
Okay.
end of 2025. And 2026 to 2027, there's another 750 outlet they plan to expand. So this is what is being covered inside the documents. And of course, you can see the one that is in darker green is the one that have the most outlet. Right?
Yeah.
The concentration is quite obvious. It's on the central, the northern, and also the southern side of Peninsula of Malaysia. And probably the east coast is still not widely covered. Same goes to East Malaysia, right? And of course, this is just a number for your reference about the number of outlet. The expansion is quite consistent for the past few years, but again, the one in central sort of slow down. The one in actually northern and southern, they are expanding slightly more aggressively compared to central, which slightly matured. And of course, the breakdown of the income is just proportionate. The number of outlet basically represent the number of income, not much different if you zoom into individuals region. And the interesting part is, so you wanted to know how much they are making every single day, right? So if you just pick one number, let's say by 2022, the full financial years, right? So they're telling you basically every single outlet, they are making about 440 sales every single day. And average sales is about 23 ringgit. And this make up about 10,000 plus per day. So this is the key number that you can take in mind. So every single outlet make about 10,000 sales per day. And I mean, the number can varies, but then it won't run far from this range. And another key metrics that typically we will look into when we look into this kind of business is SSSG. It stands for same store sales growth. And the recent number is not that great. Probably already hit the ceiling. So you can see the same store, what is the growth number? It actually slowed down, and even in 2022, is actually in negative, meaning if comparing year on year, the sales actually drops. So this is just a number for your reference. And we move on to, so what is the type of product that actually contribute into the revenue? So of course, the top part is all the food and beverage, followed by personal and also baby care products. And the last one is the household products. So this is the few key category, but if you want to be focusing into the key category is just the F&B, the cooking oils, the biscuits, the mineral waters. So this is what contribute to all the numbers. And before I go into some of the industry insight share within the documents, do you have anything to add after seeing some of the key number?
Yeah, I think if you are a retail investor or you are an analyst, you would, once you go through that, you will actually have a lot of questions in your head already. So my first question is, I don't have the answer, but I think it's a very good question and a mental model way to think. So they said they have 2,000 stores and they plan to open another 1,000 stores, right? So that means they're going to grow by another 50% from the existing size. So this 1,000 extra stores, most likely could be in the regions that have not expanded because as we see, they have such a strong presence in Penang, Kedah, KL, Johor. So these are, as we know, states or with cities or towns that have high, very dense population. So that's why you see over in East Coast Malaysia, there's not much growth there, and then there's also not a lot of stores there. Same goes to East Malaysia as well, Sarawak. So with these 1,000 stores, if most of them are going to be in these states that have not penetrated, how confident are we that they can still manage their same store sales growth, right? SSSG, because at the end of the day, convenience store is strategically set up in neighborhoods so that it provides people or inhabitants the convenience to go straight, walk 5 minutes to grab what you want instead of drive car, get jammed, then find parking, and then buy whatever you want. So that is the unique selling point. So if all the existing high density places already have a analyze speed Mart outlet, how can the company continue to grow from there? So this is my question. I don't have the answer, but if you are planning to invest into, I think you should also ask yourself this question, find the answer. So I think that's about it. And I think the very worrying part is that we see that SSSG has been creeping down. This was something we saw quite similar also for Mr. DIY. I mean, Mr. DIY still posted slower SSSG but in their prospectus, but I think that was also a time when most of the analysts, or even personally at mykayaplus, we were quite neutral, slightly bearish on the valuation the company is asking for. And true enough, today Mr. DIY is trading at a price lower than the IPO price. Of course, if you are new, you can check out the link on where we actually analyze Mr. DIY. But yeah, I think we can go on to the next segment of this IPO.
Yeah, so again, when you go through the documents, there are a lot of sections. So one of it is a full section about the industry insight is a research carried out by Frost and Sullivan. And then, of course, how they actually view this retail industry segmentation in Malaysia is technically they break it down in grocery base and non-grocery base. And where Speedmart sit is basically under grocery base and basically classified as mini market chain store. So this is how they classified Speedmart. And of course, prospectus, they're trying to portray some of the good numbers. So they are showing some of the breakdown, right? If you talk about the number retail sales value, so you can see mini market carry out about 21 percent, right? So all these numbers, and then you can see from a number perspective, it's actually going up and up. So these are some of the number they try to portray that mini market going to carry quite a bit of weight moving forwards, and all the number basically the sales will just go up, right? And then proportionately, mini market can benefit from it. And of course, another thing that they try to break it down is let you have a feel about it from a CAGR perspective. If you jump into different category, what is their performance? So they're calling out hypermarkets, supermarkets, mini markets. The CAGR, if you zoom into the recent 3 year, 2019 to 2022, is actually negative growth. The only thing that is actually positive is mini markets, and especially nice, or especially great performance from the change mini market. In this case, it's actually Speedmart. And if the one that also in positive is actually convenience store, that this is the only market that they can actually compete with them, technically speaking. So this is some of the number for your reference. But again, if you're interested to know what is the definition of hypermarket, supermarkets, you can check out the actual documents. So they have the actual explanation on how they do the classification, right? And of course, then the next thing is, if you zoom into the same category in change mini markets, what are the other big boys and how are they doing? And what is the breakdown? And of course, from a number perspective, Speedmart is basically the king within this segment. Especially if you look into the number of outlets, they are 2005. No one is actually near to their numbers. Be it MyNews, be it eConcept, and so on. But again, something for your reference. And some of the financial benchmarking they are doing from some selected grocery based retailer. And of course, some of them, the name you may not see it, like Jar Grocer and so on. But I don't know how they actually choose the player, but this is something for your reference. And again, from a CAGR perspective, everything seems to be okay, right? And then 99 Smart is about 17%. So the key thing that you should take note, and maybe something they wanted to actually portray is, a lot of people will call out their PAT margin is very low, 6% for example. But they want to do a comparison and letting you know maybe only KK is the one that are able to achieve slightly higher, which is about 10%. But again, how you read it, this is for your reference. And the inventory turnover is another thing that they wanted to also shout it out. So they are on par with, for example, people like Lotus, Aeon, Biggs, KK Mart is actually longer, like 61 days. That's why 7 days. Good reference point for you to check it out. And yeah, so some of the number, and again, inside the document, there are more charts, more numbers for you to actually check it out. we are pulling out some of the interesting ones for your reference. Do you find any thought after seeing the number?
I mean, I do kind of agree with some of the study showed by Frost and Sullivan. I think if you look at how they portray that hypermarkets have been disrupted by smaller chain, I think there is a little bit truth there, right? And if you see that Lotus, which used to be from Tesco, so Tesco also senses the loss-making scenario that was in, and then it quickly quit the hypermarket chain in Malaysia, and then sold the chain off to Lotus. So there is truth there. And I think we also see that how mini market in the likes of convenience stores like Speed Mart and KK Mart have been dominating neighborhoods, and they have also been kind of like the go-to solutions if you want to grab and buy something quick. So that one is true. But then again, I think you need to tie back to the operational metrics of 99 Speed Mart. So they say that, yeah, convenience store will still continue to grow at a very good CAGR rate. But if your convenience store continue to grow, it will also in fact impact your same SSSG, your same store sales growth. It will also impact your average sales per day, and also will impact your average revenue per day, average sales per day. So at what level should we think that, okay, this is the optimum number of stores to have within our vicinity and not just grow for the sake of growing? Because at the end of the day, you see, it's not exactly a high margin business. We'll take a look a little more on some of the key financial info. But if you do too much, you might run into potential that, yes, you might be growing first, but then you might be losing money because you will have too many operating expenses, because each store will come with rental, and also each store will come with OPEX that a company needs to pay. So food for thought about that.
Yeah, let me continue with some of the numbers since we talk about the details. So again, from a number perspective, their revenue number is quite impressive. So if you talk about the audited number, 2022, they achieved about 8 billion ringgits, right? But again, when you actually look through the cost of sales, so it left with about 700 millions, and it go all the way down to PAT. Profit after tax is about 300 over millions. So this is some number, then you may be confused with so many big number. What about the percentage? So in short, right, their gross profit margin is very low, not even 10%. It's hovering about 9.2 to 9.5, for example. And you zoom in further after taking out all the numbers, go into profit after tax margin. Even though in the research, they are using it as a reference of 6% PBT, but then the actual one that actually go into the pockets is 4%. And for some of the number for the 2022 is even down to 3.4. So essentially, what does it mean is your EPS is also very low because of the nature of the business, right? So if you continue on, if you check out the balance sheet, so this is something I won't call out a lot. Nothing big actually caught our eye. It's quite healthy from an asset perspective. Don't have a lot of unknown debts, long-term debts. Everything is under control. Gearing ratio is not bad. So this is just for your reference. And if you're interested on which segment, which product category give them the most margin, so this is the number for your reference. In short, the product that give them the most revenue, which is F&B, is only allowing them to get a GP margin of 8 over percent. And of course, the one that give you a slightly higher margin is household products, which is about 12.5 to 0.8. But again, this is only consists of about a very low percentage of the overall sales. So if something that they didn't manage to control well in F&B segment, then they might end up quite badly, right? And of course, if you continue on, there are some other key financial ratio for your reference. Current ratio, gearing ratio, all those things is quite positive. I mean, for me, it didn't create any red flags. For your reference, I mean, for the guy that actually watching right now, this is some number that you should take note. No red flag. And so this is basically some of the key information that we managed to pull out by going through the prospectus document that I think released 1 to 2 days before. Jupan, anything to add before we go into the high level take over your conclusion?
Not really though. I think financial statements wise, the company looks good, but then again, it's not just all about the numbers. There is the qualitative part and also the quantitative part. So quantitative part, nothing wrong or nothing fishy, no red flags to pick up. But I think, let's start off with the big picture or the qualitative part of the business. I start off with you first, Chunbei. Would you actually consider this stock, even though valuations are unknown, but just based on the business model and also the financials?
I think the key factor for you to consider this stock is if you're looking for stable dividend counter. In the documents, they also have actually clarified what is their payout policy, so you guys can check it out. So they make a commitment on something they will do. But again, the thing that we are not sure right now is what will be the listing price. Whether it will be crazily high valuation or whatnot, we're not sure. But again, for them on doing IPO raising funds just for expansion, where their SSSG is not really in a very good numbers. So meaning they are not in a high speed growth stage already. They already passed that stage, very stable, churning money every single days. So whether raising fund purely for expansion make sense from a return perspective, this is something you should take note, because if me to put in money for this personal opinion, I think this purely for dividends. But if you're looking for high speed growth, looking for capital gain, I think it's very, very challenging. And of course, one of the good references is Mr. DIY. About the same thing, just selling different stuff. So it's a good reference for you guys to check it out. Maybe it's not apple to apple for you to compare against my news 7-Eleven. So it's a bit unfair to compare for this convenience store. But Mr. DIY is very close. Yeah, this is my key takeaway.
Yeah, I think it's always exciting to see a company that we know, and I think most of us are consider ourselves loyal 99 Speed Mart customers, because it is everywhere, and sometimes it's just so convenient to go inside and grab something that you want, right? But I think sometimes we need to step one step back and evaluate it from an investor or businessman point of view. So not because you like the product or you like the service, then you go and buy the company share and you think that you're going to make money. It doesn't work that way, right? And I think some of the information portrayed and shown inside the IPO prospectus, you need to think a little bit more. I don't have the answers as to the questions that I mentioned just now, but it really makes me think deeper. And if I don't have the answer, most likely I won't touch it. Right? So that is the very key baseline for me. And sometimes don't take prospectus words as it is, because at the end of the day, it is selling is a marketing document with some facts and figures, but we still need to go back to a little bit of common sense. So that is just my 2 cents point of view.
Yeah, so last thing to add is, regardless, the guy that actually owned the company, Mr. Lee, is essentially still holding major part of the share. So the personal interest is there. So there's no reason why he will make this to the. I mean, he will just cash out, right? There are a lot of mechanism to control it. But other than that, it's a business model, whether it makes sense for you to put in and expect what kind of return. So all these things, ask yourself 2 times, 3 times before looking into. But again, a lot more to find out. IPO price, all those things will be some key data, key metrics to justify your action. I think this is the key thing we wanted to cover about Speedmart. Hope you get something from this video. If you like this video, feel free to put the like button and then share the videos. If you want us to cover more stocks, some other topics that you're interested, feel free to put it in the comment section. We'll definitely go through your comment and we'll try to cover it if possible. So I think that's all for today. See you in the next video.
Yes, take care. Bye-bye.